In 2020, in the midst of COVID, the oil and gas players and their market capitalization represented roughly about 10.1% of the entire Bursa market capitalization. Now, fast forward to 2026, that 10.1% has reduced to 7.5%. What has happened to the oil and gas industry? Are there still potential to invest in them? While we're recording this video, the Iran, US, and Israel war has gone on for past a week. So, how do you create a template for you to find your next multi-bagger in this industry? This video will address all of those questions. Hello everyone and welcome back to my channel. My name is John, former engineer, oil and gas engineer actually, turned full-time investor, wealth planning director at Phillip Capital Malaysia, as well as the author of the book Malaysian Multibaggers. It's already out in stores, especially Shopee, link is below. And we're going to discuss chapter 5, which is a very industry-specific chapter on the oil and gas industry. The key to investment success in a cyclical industry like the oil and gas industry is to find business models that decouple itself as much as possible from the volatile nature of global crude oil prices. Now, when I talk about global crude oil prices, there's usually two. The first one is the Brent crude oil price, which is actually a basket of crude oil prices for oil produced in the North Sea, or the West Texas Intermediate, or WTI, which is a benchmark from the US, right? So business models that decouple themselves as much as possible from volatile natures of this are those that actually thrive or actually succeed in actually returning shareholder returns from the data sets that I have researched, especially within Malaysia and including global companies as well. Now, let's start off with the first, I think the overall arching theme that you have to understand when you want to start investing in oil and gas. There are actually three subsectors. It's very broadly categorized as upstream, midstream, and downstream. Think of the upstream players or the exploration and production companies. Think of them like property developers. So the land that they're on may not actually belong to them. They could have made an arrangement where they actually lease the land, or they do a partial sale or partial purchase of the land and jointly develop this together with the landowner. So in this case, this scheme of arrangement in the oil and gas industry is called production sharing contract schemes, or sometimes they can do what we call a concession scheme. Now I'll focus on the PSC, or the production sharing scheme, because in Malaysia this is what we practice. So think of Petronas, which is our national oil company in Malaysia, as the landlord, and they invite PSC, production sharing contractors, to come in like Shell, Conoco, Phillips, or Exxon, and says, okay, you go and develop this land that I own, or this oil field or gas field that I own, and you retain the rights to actually produce oil or gas and get a share of the revenue for the next 25 years. You're the guy who operates it, you're the guy that profits from this field. So production sharing contractors, they bear the risk of finding the oil in that field, obviously coming up with money or capital expenditure to build the facilities, and also coming up with the operational risk. They have to train people to actually extract the oil from this particular PSC field over the next 20 or 25 years. So an E&P operator, they take very high risk actually. They take what we call geological risk. They also take financial risk because they have to raise capital to build, and these are not cheap these are not cheap facilities, okay? The beauty about this is that if you find a very prolific field, you can actually produce oil and gas on this field for 20 years, 25 years, and sometimes if you maintain a good stewardship of the asset, the landowner, Petronas in this case, or Petrobras in Brazil, or Pemex in Mexico, they said, hey, you did a good job, we were happy with our take, and you've maintained the facility, why don't you continue for another 5 years or for another 20 years? So that is the longevity of the E&P business model, or the upstream business model. The caveat, however, is this: as oil prices go up, and if your operating cost is fixed, then therefore the profit margins or profits actually go up. However, if your cost is fixed, or what we call OPEX per barrel is fixed, but the oil price is actually below your cost per barrel to produce, then you are sitting at a loss. So I use an example of Hibiscus Petroleum. They probably have an OPEX per barrel cost on average 20 to 25 US dollars, depending, right? But that is from the previous year's reports, that's roughly there. So what happens is if crude oil prices are at 50 US dollars a barrel, the difference in between the selling price and the OPEX per barrel, that is where Hibiscus actually makes their margin. And this is true for any E&P operator, exploration and production operator. So there's actually no decoupling. There's actually a direct correlation of crude oil prices to the profitability of the business. And that is where there is a lot of volatility in the nature of the profits for this business. That is the biggest risk for an E&P player actually. So now let's move on to the midstream, which is another subsector of the oil and gas industry. Now, what do midstream players do? Now remember, the E&P or upstream players, they build facilities either onshore or offshore to actually extract the oil. So before the oil reaches the final user or the end buyer, which is categorized as the downstream subsector, there is a temporary requirement for the oil or gas to be actually stored before it's finally transported to the end customer. And the midstream players actually either provide logistical support or provide storage facilities to store this oil temporarily before reaching the end buyer. How do the business model of midstream operators work? It's very simple. They actually pay the clients who are usually oil traders, right? Or actually refineries who actually buy this crude oil stock or natural gas stock. They pay either a logistical fee, they pay a storage fee, and the rate or the contract scheme is usually this revenue model called a take or pay. That means regardless of whether you going to store for the short term or the long term, there is a minimum requirement that you have to pay the midstream player to build the facilities to actually block that storage facility for you. Now, that is actually completely decoupled from the volatile nature of crude oil prices, because whether they store 100 US dollar price crude or a 20 US dollar price crude, the storage facility fee and everything is the same. It doesn't matter, right, to the midstream player. Obviously, when crude oil prices are high, they missed out on the upside. But similarly, on the downside, they're protected because they don't care whether it's $20 crude or $100 crude, the charges are there. That is the beauty of the midstream subsector. So players within this space in Malaysia, the biggest one of them is actually Dialog Berhad. There are actually many other guys, especially in Singapore, people like Oil Tanking, people like Vopak in Holland, right? And obviously many others in the US, which has a bigger in terms of volume oil and gas industry. But by and large, the model roughly is the same, where there is a storage, logistics, facilities leasing fee charged by the midstream players. There's another model in between the upstream and midstream player, and I like to call it the floating landlord model. Now, instead of building a fixed facility offshore, some oil and gas E&P players, they rather build a floating or mobile kind of oil and gas facility. These facilities are usually called floating production, storage and offloading, or FPSO for short. Now, one of the biggest players in the world, not just in Malaysia, is actually this company called Yinson Berhad. So what they do is they either build a fresh new ship that does production, it does storage, and it also does offloading to oil tankers, right? Or it takes an existing vessel and it converts that, which is sometimes faster, and leases it out to E&P players, upstream players around the world. Now, they've grown their business by leaps and bounds from being the 9th largest operator. Today, they are the 3rd largest operator in the world. and it can range geographically from all the way in Latin America to the coast of Africa, and even in Malaysia. So they how their unit economics or how their revenue actually works is this: they charge the client a charter rate, a day rate that is regardless of oil price. The disadvantage is that if oil prices go up, they do not get to raise their charter rates based on this oil price up or down, right? But on the downside, if the oil prices go down, the charter rate also remains the same. So in somewhat, I say it's in the middle, because remember earlier when I mentioned upstream operators, their profitability and margins are tied to the volatile nature of the crude oil price. Whereas for the downstream players, they get paid a storage fee, a logistics or facilities fee for lending out the facility. So FPSO is somewhere in the middle because it's slightly more upstream. It's actually offshore. It actually does production services, but it also stores, and they are paid a lease rate regardless of volatility nature of oil and gas prices. That is this floating landlord model that I mentioned earlier. Now, the last subsector is the downstream model and the downstream niche. And these are usually refineries that actually further process crude oil into usable petroleum products for all of us. Think, for example, your RON 95 or RON 97 petrol, your lubricants, your kerosene, your jet fuel, your diesel, your bitumen that is being used for tar road pavement. This is where the downstream or refinery players actually play. And a few big players in Malaysia will be someone like Petroleum Malaysia, who also has a trading arm. People like Heng Yen, which used to be Shell Refinery in Malaysia. And in this space, the unit economics or the revenue model is based on this thing called crack spread. So what is a crack spread? Crack spread means the cost of feedstock. In this case, it could be naphtha or crude oil petroleum versus the price of which they sell their end product. That gap in between is the crack spread. How much is your input cost versus how much is your selling cost? Now, usually downstream players have a margin of, if you're lucky, anywhere between 6 to 7%. Usually it's actually lower than that. It's a very tight margin business. And this is a sector of the business that it's very, very difficult to make good money, because imagine for you to build an oil and gas refinery, to be able to refine crude in the most efficient manner. It's actually a very big capital outlay. At the same time, you are exposed to the volatility of your input costs, and you cannot immediately pass on that cost to the clients that actually buy your crude, buy your end product. Your jet fuel, your plastics, your methanol, your ethanol, or whatever derivative that you refine this crude or petroleum to. So yeah, there you go. You've got the upstream business model, you've got the midstream business model, and you've got your downstream business model. Obviously, the further along towards the client, those that decouple. Remember, we started with the objective to say the guys who actually, the oil and gas players that actually survive and actually thrive, were those that decoupled themselves and their business models from the volatile nature of the crude oil prices. And therein lies, observing history. Those guys that really decouple are the guys that actually multi-bag, rather than the guys who are, in the upstream E&P space, where capex outlay is very big, volatile nature of crude oil prices. And if you go to downstream, volatile nature of your feedstock and volatile nature of your final price with a very thin crack spread. So, if you want to know more about this sector, obviously there's a lot more nuances that I describe in more detail in my book. Check out the link to the book in the description below. There will be a book signing ceremony on the 28th of March in MPH TRX at 2 p.m. And I look forward for the purchasers of the book to sign a copy of the book and to interact with you and to take your questions there. I look forward to seeing you in the next video.